All right. Good morning, everybody. Just give it a second while everybody gets in. We've got two big events today. They'll both happen after the open, and I seen quite a bit of red on the headlines. We have a high risk probability coming from the White House today. Keep this one on your radar. I think it's going to be bigger than any of the economically scheduled events for the day. This one very likely will be the narrative for the day. The call wall and the put wall are in the same spot. We didn't get a move in that. We can see the NASDAQ up 1/4%, Japan down 1/2%, and everything else scattered in between. So it's a bifurcated market this morning. So there's PMI and ISM services. As I mentioned, it'll be after the market opens, and there will be job openings data today. Remember, we're going to see a lot of jobs data this week, and we're going to not get jobs data this week because of the government shutdown. So markets are going to have to run blind on that. We were just getting past all of that missing data from the last government shutdown, and now we're running into it all over again. So it's going to be kind of a big deal. I did see that about Pepsi. I am a Pepsi drinker. I can't stand Coke, and uh, and yet I live in the middle of the United States, and this is not Pepsi territory. So that kind of sucks. Go to most restaurants and they want to serve Coke products. I really miss the South. But, it is what it is. Uh, it's one of the things that keeps me from wanting to go out to eat. So I guess it's a good thing. But Pepsi's getting punished. They had a reasonably decent earnings, and yet they are getting punished this morning. And yeah, I agree with you. Any company that's going to lower the cost of their goods and services, yeah, it makes a good headline, but seeing and believing, right? So once we're done with the morning session, the only thing we have left on the agenda is things that could hit the news, shock and awe, things out of the White House, that sort of stuff, right? I believe there was supposed to be some auctions today. There they are. So we're going to see the 30-year auction today. The QRA came through yesterday. Um, Talk about no bubbles, right? It There was almost no change. And if you haven't really focused on QRA before, you really don't get much of a reaction out of the market if they're just going to continue to do the same old, and that's exactly what they're doing. There was one proposal about the 7 year, but this is more of like what do you call it, like administrative um, shenanigans. Other just they're wanting to normalize the way that the 7 year is done to make it more in line with the way, say, the 30 and the 10 is done. So, and even that was brought up as a proposal. They're taking statements, so we might not even see that normalized. But if it does, fine. It just brings everything closer to uniformity, if that word fits, but it doesn't change the proposal any. So QRA tomorrow, when we finally do get the numbers, is very likely not going to matter even a little bit. So that's the way it goes. If there had been significant proposals, then QRA would have really very likely rocked the boat. But we didn't get that. And how do you prove a negative, right? There's all this talk about how the guy replacing Powell is just going to be a puppet and a mouthpiece for the president, and he's just going to do whatever the president wants him to do. And if that was true, which I'm not saying it can't be true, but if it was, why is the market not pricing in 2, 3, 4, 5 cuts, right? Because the president's been pounding the table and trying everything he can try to get the Fed to cut. And if he was to put this new person in who's supposed to just do whatever he wants to do, then why are we not seeing the market price in 3, 4, 5 cuts this year? I don't have an answer to that, by the way. I'm just throwing it out there. If this guy is supposed to be such a puppet, not an independent thinker, not someone who can, run systems the way they're designed, but instead is just going to be the puppet on a string, where's all these rate cuts? Why are they not being priced in? Okay, something to think about, huh? Precious metals turned around and started heading back up again. They're not done yet, so they say. Just remember that we are witnessing volatility at its finest. And this big red bar here, or even this big red bar here, says that we're in volatility environment. We could bounce on silver all the way back up to 100 or 105, even 107. Any bounce at all that does not get back to the previous high and instead stalls out with a lower high offers more to the downside. Now we fell below 65. Not by much, right? Maybe we just wicked down there, but we fell below 65, or we fell down to 65. Yeah, I was right, below 65. Close enough, right? From what, 105? No, even higher than that. 110 to 65. I don't care how big the bounce is. If we fail to make an equal high or a new high, then we could roll over and come right back down and break that low with a new low. So if you're thinking about buying the dip in precious metals like silver and gold, be very mindful of the fact that this could just be a bounce into resistance before we roll over and we break support and put in a lower level of support, right? Just thought I would put that out there because that's textbook volatility. SpaceX has acquired XAI. This is nuts. If you guys have been listening to This proposal, the amount of money wrapped up into this is absolutely insane. And then he was talking about how many satellites they were looking to launch. We're going to have more satellites up there than stars. I hope not. All right, so it's very likely that today's just going to be a day full of headlines and drama and chaos that isn't a part of the scheduled calendar. All right, so on these kind of days, you need to be very particular and watch the narrative, right? And as I mentioned yesterday, um, we got a long ways to go, right? There we go. The Europe wrap. So I don't show this often enough, but it's worth mentioning from time to time. Finance Juice does a market wrap for the three major markets around the world. They'll do a pre-market wrap and then they'll do an aftermarket wrap. Now Europe is not closed. They do us a courtesy and give us a European market wrap because they know that the US is waking up and getting ready for the trading day. And so they give us Europe's market wrap early. So you get this, which is really going to tell you about what was happening in the overnight while you were sleeping. And then after this, they'll give you the pre-market briefing, which will line you up with things that had earnings or anything that's on this schedule for economic events and just really good info. So if you don't stop by Finance Juice and pick this up, then you're really missing out. And a lot of times, sure, it doesn't have anything in it that I didn't already know, to be fair. But sometimes I find things in there that I didn't know about, and that's kind of the whole idea, right? You don't know until you look. And it's free, it doesn't cost you anything, so why wouldn't you look, right? So swing by, check it out. If you don't have an account here, even just a free one, I highly recommend that you get a free account. Again, it's free, it doesn't cost you anything. The free account allows you to use this button right there. That's a filter. This is a news aggregate website. It's fetching news from all over the place, which is great, but some news is better than other news, right? I don't want MSNBC and Fox and CNN and that kind of trash. I just really don't. So I don't want it to waste my time showing me things from those sources. If you have no account, you would have to use this filter every day, come in and weed those things out, and well, that would just get monotonous really fast. So make a free account and then use the filter and remove those sources and then save it so that it's always that way when you come over to this site and you don't see those sources. Of course, I have a pro account, but you don't need it. All right, we're looking at around 67,000 in the overnight. Half of what we had yesterday, but more in line with a normal trading day. So we were getting a little elevated between Friday and Monday, well above 100, but now we're kind of getting back to normal. It shows decent participation and kind of implies that everybody was here last night. We're back above VWAP this morning, focusing on that inside day breakout. It was a nice reversal. I was playing on this earlier. Kind of expected it to get a little deeper, and it wasn't the best reversal here, but we got the job done. Ran it back to VWAP. There's always questions about trading in the pre-market, and if you don't do it, you're not missing anything, right? Trade in the regular trading session, but I mean, if you're already awake, why not? Main thing now is that we're focusing on this inside day breakout, and we kind of want to keep the breakout. This is a little odd. Normally, if you get a breakout and it fails, you don't get another shot. And we did that. And then that one failed. And it's very rare to fail twice and then still get another shot. But here we are giving it another shot. The third time's a charm, maybe? Don't know, but this kind of breaks the mold here because it's not normal to get that inside day breakout and then see it fail multiple times and still yet again go for another inside day breakout. That does kind of highlight the strength of this push. What we get out of it, remains to be seen, but the call wall is a long ways off. That really isn't in the cards today unless we get headlines that we can't see coming. So I wouldn't try to focus on that. But as we'll see with the ADR, we have room. So we'll just see how far we can get. Just wanted to point out how odd and rare it is to get that inside day breakout and then have it fail and then get it again and have it fail and get it again. So there's a lot of pressure on the bottom of this to lift it. Sideways continues. This is the daily chart. You can see the moving averages are all fanned out nicely. Good spread. We're not too far away from that white line. That's the 3-period daily moving average. The concern at a glance is just how far away are we from that moving average? We don't want to get too far or we end up mean reverting back, right? We're not too far at this point, but by the end of the day today, or by the time we get to the edge of the ADR today, it's possible we would have exceeded that distance for the day. And that lines us up with a pause at the ADR the way it's supposed to. Just nice when everything works out, right? When things do what they're supposed to do. All right, what I've got measured right there is just the RTH of yesterday. And that's going to give us a narrower 111 and a narrower 1236. And you can see that's where the reversal happened when we got that breakout of the yesterday's high, right? So that's yesterday's 111. It's one of my favorite trades. We call it yesterday's 111. Even if price runs up and hit the 1236, the name of the strategy is yesterday's 111. But now we're going to measure the entire trading day. And as you could imagine, that expands the upper edge up here, right? So now the 111 is really close to the 1236 of just the RTH. So we could continue to push to the upside and get into 70.32 cog line. If we can get past 32, then we'll aim for 52, which would be a 1236. That would also get us through the ADR half and get us moving in the direction of the ADR full. But by that point, we would have expanded too far away from the 3-period daily moving average, and then we'll have to be concerned with a reversal because we would have traveled too far too fast. The average daily range right now is 1.06%. We've only traveled 0.27. So we haven't even gone half of the ADR at this point, which makes sense because that's our red line and that's our red line. If we had gone halfway to the ADR, we'd have reached one of those two red lines by now. The base case scenario is that we hit this upper line since we have all that pressure underneath the market, stopping us from falling back down. You could focus on the midpoint of this Globex range. Getting back below the mid offers the low, and then getting, of course, below our own Globex low puts yesterday's half on the table. You know, it's funny you ask about Head and Shoulders. That's usually the butt of all jokes, right? At least in my trading world, we use the Head and Shoulders as kind of a joke pattern quite a bit. Maybe on the daily or the weekly, it has more value, but on the intraday, it's usually just something that we laugh and point at. So that's a good question. Someone asked about this indicator for TradingView. All the indicators that I use in this stream are in the YouTube description. And I rebuilt these charts on TradingView. The only charts I don't have on TradingView are the charts that need options data, like the weekly expected move. So you could go over to the video on YouTube, like and subscribe while you're there, help me out. And then look at the description for the YouTube video and you'll see all the links for these charts. And I just shared the whole chart already built and it has the indicator in it. That way you don't have to get the indicator and adjust the settings and put it in the chart. You just get the entire chart, right? So if you want the indicator on TradingView already set to the levels it needs to be set, you can just go to the YouTube video, look in the description, and grab it from there. The floor pivots are on top of each other today. Today's floor pivot is really wide. Wide channels imply that if we break out, it doesn't stick and we come back in again. Just remember that these channels don't make price break out. It doesn't stop price from breaking out, and they don't interact with price, right? They don't make price do anything. So it's just perspective. This wide channel says we shouldn't continue a breakout if we actually do get a breakout. Well, we've already broke out multiple times now, and we haven't been able to keep it, but it keeps trying. So if we do break that Globex low and begin heading back down again, keep your eye on the pivot point for today. It is the daily and it is the weekly. They're laying on top of each other. We haven't traveled farther away from the weekly pivot that we need to be concerned about any sort of reversal or mean reversion or anything like that. But we have gotten a bit far away from the daily. The problem is yesterday was such a wide day that today's levels are really far apart. Just to put it into context, I'll zoom out here a little bit and you can see because Friday was really narrow, Monday's levels were really close together. But because of the distance that we traveled yesterday, which was really far, today's levels are really wide. So we haven't even made it to R1 yet because R1 is so far away. If we continue to push to the upside, just getting to R1 would be an accomplishment. If we manage to fall down and challenge the central pivot range here, get through the top, get through the pivot, then the bottom, then S1, level by level, as it always is. We got the classic P-shape profile happening so far this week, with the distribution in the upper part of this profile. So we need to keep above 7,000. It's likely if we get underneath this high distribution zone that we're going to have a hard time coming back up through it again by the end of the week. So we don't even want to give up on it, right? Want to keep it. We have a little bit of help around the 69.90 area, but really those three different distributions last week didn't seem to slow price down at all, and we just ran up through all of them, right, off of this low down here. We ran through every one of these. Now we're kind of negotiating this top zone, and I wouldn't be surprised if we bring this point of control up to 70.11 cog line. But I find it hard to believe that we're going to be able to maintain this 22-point range for the rest of the week, right? It's only Tuesday. Now, we can do it. I've seen price do it before. So, hopefully we've all learned by now price can do whatever the hell it wants to do. It would just be very rare for us to stick for the rest of the week in this 22-point range. And goodness, next week would be such drama if we actually did do that, right? So technically it's possible, it's just not very probable. That means we got to get out of this box, right? And when we get out of this box, where are we going? That's kind of the driver, right? The big takeaway. Looking at it on this time frame, this 30-minute, we have that lower high here forming, right? The high, and here we are developing this lower high. So if that fails, it's very likely that we'll be looking at a lower low. Over the next 2 days, we're going to be removing more of these candles from the left. That's going to narrow our zone here a little bit. But as we mentioned yesterday, this drop kind of ensures that we're not going to lose very much of the profile, maybe 40 points. So that didn't narrow us up very much. Still looking to see the 10-day, 30-minute TPO and volume profiles point of control get moved up to the 70.11. All right, we took out that VPOC from Friday. We're done with it now. But we're just going to take that line and carry it forward to here. Now, I'm not one for zooming in and getting it right to the tick perfectly. It's close enough is close enough. But there's our VPOC level. This is an untouched point of control. That's what the V stands for. It just means untouched. It's a volume profile. I don't need to put a P there to tell you that it's volume, right? What other profile am I running? I'm not. So, common sense. The V doesn't need to stand for volume. It's virgin or untouched point of control. We have a bit of a discrepancy between the TPO and the volume profile here. You see these 2 points of control are in different locations. It's very likely that they'll sync up. This is like your classic distribution, straight out of the textbooks, right? It's your bell curve classic. We got no insight or value at this point from this, other than we're just in distribution and the market seems content to stay in it. Even across those highs, a little bit of highlight, but not enough to stand out. And same thing across those lows, there's just nothing here. So no real tell on the turns or the edges, and just running in a normal distribution at this point. Day one open range is complete. We're working to get our break out of that. It's not designed for futures, really. I tried applying it over the course of the last few years, and it really just doesn't fit. But this weekly expected move indicator gets used on more than just the ES, so I built it into it. So that's why that candle is yellow. I don't need to really focus on that. We're above Friday's close. We're trying to get a breakout of yesterday's range. And like I was talking about with silver earlier, this wide candle distribution here, all these big bars, are a sign of volatility. Now you can look at volatility indicators. You can get all strung out on the difference of the different volatility indicators that are out there. But when it comes to volatility, the easiest way to identify if we're in a volatile environment is to look at price action. The volatility indicators like the VIX can give you a number so that you can put some mathematics to it and say that we have, quote, this much volatility, right? Kind of like a speedometer. You can drive your car without it, but then you're never quite sure of exactly how fast you're going. So the VIX as a tool gives us a number for that volatility. But if you want to see if we're volatile or not, just look at price action. These big bars are showing us that we've got volatility. It's likely to get worse before it gets better unless we get out of the range. So we've been building this range for a while now. Until this changes, then this is just going to get worse. 70.70 is the upper edge of the weekly expected move. We're not there yet, obviously. So that's the goal if we continue this upside push. We're halfway to 1%, so we're 0.5% above the 10-day. It's moving in the right direction. We have room to the upside. We're not overbought. We're not overextended. We haven't moved too far too fast, and it doesn't owe us any sort of pullback or mean reversion or least squared methods or anything like that. Yesterday was a big move. So focusing on, hey, did we move too far yesterday? It's a really good question. Now you can use Z-score and other models to anticipate or to quantify how far is too far. I like using the 10-day. If you want to swap that out, you could use the 3-day. That's a really good model if you're running real short-term stuff. But between the Z-score, which tends to confuse people, and the 3-day, which I think is just a little too close, the 10 is perfect. And this says, no, we didn't move too far too fast. No, it doesn't owe us a pullback simply because of how far we moved. That's good enough for me. I'm still looking for my breakover haven't got it, this is our distance from the 10-week. We are more than 1% away from the 10 week, so we've escaped that kind of gravity or magnet. That changes the pace of the tape and the volume that we would see from options traded around that 10 week. Now we've begun the expansion. It's possible we could finally get that breakover, but don't know, right? Got to wait to see how it plays out. The main thing here that we're looking for is, have we moved too far? Nope, we haven't moved too far. All right, looking at what's down this morning, the Mag 7 down volume is down. Yep, that's a double negative. VIX, China, more China, all down at least a 0.5% or more, which is the benchmark that I use because of how early we do these briefings. If you're cycling back through all of this on your own later in the morning, say before the open, use a higher benchmark than a 0.5%. Anything greater than that 0.5%. Use 1% or 1.5%, right? I just use a half because of how early it is. Looking at what's up this morning, what's up? Gold miners, uranium, Mag 7 up volume is up. Metals and mining, UFO, chips, quantum, China through the EEM, which is a little odd because all of the other China ones that are down, but we basically throw EEM in the China box. Tech, growth, Bitcoin. Those Bitcoin names, a lot of talk over the last week or so about all those companies that were trying to do what MicroStrategy had been doing. Right? And we had a list for a while. I started to rebuild the list this morning because, there's been new products that have come out since the last time we put that list together. There's a new big name, BSTR. Depends on what you're using. You could look up CEPO, but it would still be BSTR. BSTR is the token, and the symbol would be CEPO, Bitcoin Standard Treasury Company. It's a massive Bitcoin treasury vehicle. Now, I'm not talking about these Bitcoin things as a tradable thing, not even a little bit. They're used for evaluating risk as far as I'm concerned. So, keep your eye on those companies that were trying to mimic MicroStrategy because they are a great tell for risk. Plus, if they do all start to unravel and start puking out their positions that they've been accumulating through 2025, then Bitcoin and Ethereum and all those other ones are going to get slaughtered, right? They're just going to get massive rip. And I will share the list once it is built. I ran out of time because I had to do the morning briefing. So, yep, let me get the list finished because I'm breaking it apart between the pure plays and the mining pivots, and then the altcoin and the other companies that were staking treasuries. And that way it's divided better. So one thing I like about TradingView when it comes to their watch lists, the ability to add these little dividers into your watch list so that you can spread things out a little bit. Looking at the S&P 100 companies that are above 0.5% this morning, we've only got 10. A couple of semiconductors are in that list, almost half, really. Looking at the number of companies that are down at least 0.5%, we got 18. And a couple of those are semiconductors too, Texas Instruments and Qualcomm. But there's nothing here this morning. So if we're looking for market breadth, to do some heavy lifting, this isn't going to get it done. But on the other side of it, it's not negative enough in the names that matter to give us a beatdown either. So if we're looking for this inside day breakout to continue, then it's going to have to come from something other than the market breadth. Treasuries, commodities, 0-day flows, something. But what we've got up in the pre-market right now isn't going to get it done. So we're going to have to look somewhere else. Keep your eye on the market breadth as we get into the open. It can always change. Otherwise, look for corresponding VIX levels, or see if the moves in the FX markets or commodities are giving us any sort of assistance. But from where it stands right now, we just don't have the push to get this done. So we need something, a macro trigger, something, and we don't have it. Remember what I talked about with matching highs, by the way. That counts for silver just as much as it does here. We've been trying to get this inside day breakout to stick, and we've set the Globex high. If we fail to come up and match this high or make a new high, it's very likely we're going to come down and we're going to break this low and start putting in a lower low. And that should, turn everything around and have us start working to the downside. So it doesn't really matter to me, right? Whichever way we go, we've got to trade. We've already laid out the levels. So, if we go up, run it level by level. And if we go down, then we just run it level by level. Doesn't matter. So what I got for you guys, be careful, be safe, watch the clock. I'll see y'all tomorrow.